Good morning. Time now a few minutes after 8 o'clock in the morning in Tokyo, Friday, December 17th, 2021. Welcome to another edition of the World Bank Group Morning Seminar organized by World Bank Tokyo office. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. During the calendar year 2021, we organized 43 online seminars to introduce the latest report by the World Bank. Our final morning seminar, marking 44th session before the end of 2021, will feature a new report, The Changing Wealth of Nations 2021, Managing Assets for the Future, which was released on October 27. In fact, we had a face-to-face seminar in Tokyo to introduce the 2018 edition of the Changing Wealth of Nations report, and that was held in March 2018. Connecting from Washington, we have three experts, and let me introduce each one of them very briefly. Firstly, we have James Cast, a senior economist in the Office of Chief Economist for Africa region. Good morning or good evening to you, James. Can you hear me?
I can, yes. Thank you.
Great. Thank you very much. Welcome to our seminar. Secondly, we have Grzegorz Peszko, the lead economist in the Environment and Natural Resources and Blue Economy Global Practice. Good morning, good evening to you, Grzegorz. Thank you very much for joining.
Oh, pleasure to be here.
Great, thank you. Thirdly, we have Stephanie Onda, the senior environment economist in the Environment, Natural Resources and Blue Economy Global Practice. Good evening, good morning to you, Stephanie.
Very much. It's a pleasure to be here.
Great, thank you very much. So we'll listen to the keynote presentation by three experts sharing the main point of the report in the next 30-40 minutes. After that, I'll read your questions sent in advance. Thank you very much for sending those questions. Please send more questions using online form posted on the announcement page for the seminar, or you can simply post your question on the chat section of the YouTube screen. I'll read your questions asking the speakers after their presentation. With that, I would like to invite Jim, Grzegorz, and Stephanie to formally start your presentation. Over to you. Thank you.
Great, thank you. I hope you can see the screen with my presentation.
Yes.
Excellent. Okay,
yes.
Let me get started. So thanks very much for the introduction and for the invitation to come and speak with you all here today. It's a great pleasure for us to share this new World Bank report with you. As you heard, the name of the report is The Changing Wealth of Nations 2021, Managing Assets for the Future. This is a large report, significant team effort, several editors. I'm one of the editors of this report, but the many collaborators from across the world have contributed to this report. It's both a report and a database, a large database measuring the wealth of nations for 146 countries, spanning years all the way back to 1995. And so I encourage you to visit the World Bank website to download the report, the policymaker summary, as well as the database, and browse that at your leisure, particularly if this presentation today captures your interest. So we're just going to share with you some of the main findings, the approach that we take in this report, and then open the floor for more questions and discussion, which we look forward to after these few slides. So this is the fourth report in a series. The series goes back to 2011, where the World Bank began this process of developing measures of comprehensive wealth. The theme of this year's report is managing assets for the future. And this means we're thinking not just about the historic measure of wealth and how that has changed across time, but also thinking about how policy and changing global conditions will shape the wealth of countries in the years to come. So that includes questions of how the COVID-19 pandemic and associated economic shocks might affect nations' wealth going forwards. But also it means thinking about the potential impacts of climate change on wealth and how policy choices might shape wealth going forwards. So one example of this that we consider is how climate policies and global decarbonization puts at risk the wealth held under the ground in fossil fuel reserves. And so we explore what policymakers can do today to manage that risk. The Changing Wealth of Nations is part of the World Bank's work to help policymakers look beyond GDP. So the idea behind this is that measures of comprehensive wealth can be a really useful complementary economic indicator, not to replace GDP or measures of GDP growth, but to give us a different kind of perspective on sustainable development. So GDP is great for measuring economic growth and comparing between countries. But the problem with GDP measures alone is that they can be boosted. You can boost GDP growth in the short term by actually depleting or degrading your natural assets. And so that's not very good for longer term sustainability. So what wealth accounting and wealth measures do is they allow you to also track the underlying assets that are essential for generating the income that goes into GDP. And so what you can say then is that GDP is sustainable only if that underlying asset base is not shrinking. So you want your total wealth captured in these different types of assets to be growing, as well as your GDP to be growing. One of the measures that we report on in this database and in this report is changes in wealth per capita. And that's a really useful indicator for getting at this measure of how the asset base is changing overall. And that can tell us about sustainable development. So this is a schematic of what goes into comprehensive wealth measures. So you'll see that it covers a wide range of different forms of capital. So produced capital, commonly measured by economists we know well, covers things like buildings and machines and cities and so on. But we add to the measure of produced capital measures of capital that are not so commonly measured by economists. So this includes things like natural capital, where we distinguish between non-renewable natural capital, which covers things like fossil fuels and mineral resources, but then various different assets under the heading of renewable natural capital. So we measure the value of cropland and pasture land, of forest and ecosystem services, protected areas, of fisheries and mangroves, and so on. And then we include measures of human capital, which is calculated using the expected lifetime earnings of the working population in different countries. And these add up to form wealth, which is then the underlying asset base that generates income, which is what goes into GDP. And what we know is if wealth per person is growing over time, then the overall asset base is expanding. So what does this look like in the new report? What do we find? Well, this is one of the ways we can illustrate the data, which is showing changes in wealth per capita over the whole span of our data series, so right back to 1995. And you'll see quite a mixed picture. The countries in green are those that have had the largest increases in wealth per capita over that period. The countries in red are those that have actually had declining total wealth per capita since 1995. So you'll see several Asian countries have had remarkable increases in overall wealth per capita, as well as other countries like Ethiopia, Mozambique, parts of Eastern Europe and parts of Latin America. Meanwhile, 26 countries saw either declining or stagnant wealth per capita, as its wealth was outpaced by population growth, leading to a negative net increase in wealth. So nearly half of these 26 countries are located in sub-Saharan Africa. But what does it mean to have declining wealth per capita? Well, it could mean that the investment rate is too low to be increasing the overall asset base. It could mean that a country is depleting its wealth and its assets by extracting fossil fuels or mineral resources, but then failing to reinvest the proceeds from that in other forms of capital, in renewable natural capital, in human capital, in produced capital, enough to overcome the effect of the depleting asset. Or it could mean that high levels of population growth make it hard for, even with increases in overall assets, for those assets to keep pace with population growth. So if this trend continues, then it means that future generations in these countries will be worse off than present generations. So this means that the way in which they're managing their assets is going to be unsustainable into the future. So this points to bad news, not just for economic sustainability, but potentially for environmental sustainability. We find that many of these countries in red, the ones with stagnant and decreasing total wealth per capita, also have stagnant or declining levels of natural capital per capita. And so this gives us a window into the overall environmental sustainability as well as the economic sustainability in these countries. So we can dig into each of these countries and each of these assets using the underlying database, and you'll find this in the report. And my colleagues Grzegorz and Stephanie are going to take you through some more of the insights that we get to. Thank you.
Thank you, Jim. So I'll be continuing with sharing with you some key findings of the Changing World of Nations 2021 report. First of all, let us look at the wealth per capita across different countries. Here we see that wealth per capita in Japan is lower than total wealth per capita in the United States or Australia, but still significantly higher than in China, Russian Federation, let alone Bangladesh. So what strikes immediately is this huge disparity of wealth per capita across the wealthiest OECD countries and the lowest income country. And Bangladesh is not the lowest income country in the world. But in this case, the average American is 30 times as wealthy as average citizen of Bangladesh, which is a concerning point. And among the high-income countries, you can see that in Japan, the level of produced capital, the yellow bars per capita, is more or less similar to United States and Australia, and the big difference is attributed to the lower human capital per capita in Japan. Next slide zooms into something that on the previous slide was just a little sliver, which is Japan's composition of renewable natural of natural capital. And most of this natural capital in Japan is renewable. Most of the wealth in natural capital is renewable. In this small, very tiny squares and rectangles in the bottom right corner represent the non-renewable natural capital, natural gas, oil, which is very small in Japan. So most of the Japan's natural wealth is renewable. And you can see that, for instance, standing forests, the ecosystems provided by the forests, account for as much wealth as the cropland, as the agricultural land. This does not even count the value of timber contributing to the value of forest, which is a separate here category representing 6%. So both cropland and forest account for a little bit less than 1/3 of the total natural capital wealth in Japan. Certainly, this structure is very different for countries that are large producers and exporters of fossil fuels. And in Saudi Arabia, this graph would be totally dominated by the value of subsoil non-renewable assets. Next is the important story of the human capital. Here there are a couple of messages. Well, first of all, that we humans, we represent the highest share of our own total wealth. And it is about the numbers of us. It is about our skills. It is about our health. It is about our expected lifetime. Because all this determines also the lifetime earnings. And here we calculate human capital as the present value of the future earnings for labor force employed today, as well as the labor force that is self-employed. So human capital is about 60% of the total, 64% of the total wealth. What is, however, interesting and concerning is that the growth of human capital per capita was very different by different income groups. The largest rate of growth of human capital per capita is attributed to, has been observed in the upper middle income countries, driven mainly by the huge boost of earnings per capita in China and India. Interestingly, the lowest growth rate of human capital was observed in the high-income non-OECD countries. And here, this very sluggish growth of human capital per capita is mainly attributed to the countries who are very rich in fossil fuel wealth. So countries that depend on natural resources tend to have a very slow increase of human capital. And in the Changing World of Nations, we have a chapter 12 that discusses why and how the abundance of non-renewable natural resources is reducing the accumulation of human capital, which can be seen as another evidence, another symptom of the resource curse. What is also worrying is the inequality between human capital per capita. This equality has widened, has increased over time. For instance, in 1995, human capital per capita in OECD countries was almost 20 times greater than the human capital per capita in the low-income countries. In 2018, 30 years plus later, this increased from 20 times difference to staggering 70 times difference in terms of human capital per capita between the highest income OECD countries and the low-income countries. There is also significant worrying disparity between the male and female human capital. So since 1995 to 2018, the share of female wealth in total human capital increased, but very little, from 35% to 37% compared to the human capital of male population. The lowest disparities, the greater equality between genders, access to earnings, is observed in the Latin America and Caribbeans. But for instance, in Southeast Asia, female account for only 13% of total human capital per capita, dramatically less than men. So that means that much less women have access to paid employment, to self-employment than men. And those women who work, they earn significantly lower wages than their male counterparts. Next, look at one particular story of the natural renewable capital, which is non-trivial also for Japan, mangroves and fisheries. So in Japan, mangroves and fisheries accounted for 2% of total natural capital each. But looking globally, the trends in this blue natural capital consisting of mangroves and fisheries have been declining. So the total value of blue natural capital has been declining, and it has been mainly attributed to the dramatic fall of the value of fisheries, which over the period 1995-2018 collapsed by staggering 83%. It is mainly due to the overfishing, which is driven by perverse policies, mainly subsidies, as well as the rising costs of fishery. All these factors have undermined dramatically the marine catch fisheries wealth. We are not counting here the value of the fish farms. But this dramatic loss of fisheries, of the value of fisheries, was partially compensated by an increase in the value of mangroves. Interestingly, if you look at the physical area of mangroves over the period 1995-2018, it has decreased. However, the value, monetary value of this smaller area has increased 2.5 times, mainly because the value of produced coastal capital, hotels, ports, building structures, infrastructure that the mangroves protect has significantly increased in value in this time. So the value of mangroves that protect this important assets have also increased. And so that means that going forward, investments in mangrove restoration can yield really high return to the economy, especially as the sea level continues rising, the storm surges becomes more frequent and more devastating. And as coastal built infrastructure becomes even more expensive, then the value of mangroves will increase. So that means that going forward, the investment in mangroves restoration can be really beneficial to society. Next is especially zoom in this edition of Changing World of Nations, zoom into the value of the fossil fuel assets across countries and how this value can be influenced by the global low carbon transition. So it is widely expected that the global low carbon transition, the global efforts to achieve the goals of the Paris Agreement will decrease the consumption of fossil fuels. So there is this whole story that it means that a lot of fossil fuel assets will be stranded, that their value will be much lower. So we use the wealth perspective and the wealth accounting to bring much more realism, rigor, and show a bigger picture to this whole debate on the stranded assets, which often is quite political and advocacy based. So we have calculated that the value of fossil fuels can be more than $6 trillion lower in the most ambitious scenario of climate action compared to the business as usual, which is expected by the owners of these assets. But we would encourage not to pay too much attention to this highest value, but rather to learn something important from the differences in the distribution of stranded assets between scenarios, between fuels, and between countries. So we run macroeconomic global model with several exploratory what-if scenarios to represent a deep uncertainty about the tipping points of low-carbon transition and hence the distributional value of fossil fuel assets across different asset classes in different countries. So we found that some interesting patterns and interesting findings for the conversation about the global incentives to cooperate on climate change. For instance, what we found is that the value of fossil fuel wealth declines much slower than the physical output. So the consumption of fossil fuels is going down much faster than the value of remaining assets, which is a very good news, both from the point of view of climate, because the temperature is mainly a function of the fossil fuels that are burned for volumes of consumed fossil fuels. But it's also a good news for the owners of the remaining fossil fuels, because that means that they are not losing as much, and then the low carbon transition can be not as disruptive for them as some of them might fear. So it should reduce the resistance to low carbon transition. And it's interesting, that our model, which is a global general equilibrium model, shows that the volatility of prices of fossil fuels and hence rents will increase in low carbon transition. And this volatility will be accompanied with a total increase of the unit rents for fossil fuels. And I think the recent events where there was a big demand shock, several suppliers exited the market. Then when the demand rebounded, the supply is not of fossil fuels is not as elastic as demand. So that means that we have this price spikes at the moment, and this is very much reflected in our policy analysis, in our modeling. So there are several other findings that you can find in the chapters of this global of this work. Then the last story is about the renewable energy. So for the first time, we have looked at the wealth of nations that is still unaccounted for. Interestingly, so countries do include the value of fossil fuel assets in their balance sheet, but almost nobody is including the value of renewable energy on the same terms as fossil fuel assets. So we have developed the pilot account for renewable energy as an economic asset, calculating the economic rents of renewable energy for 15 countries, and for hydropower, solar, and wind energy. Here are the results for Japan, which are quite representative for the rest of the world, where hydropower, which is an established and mature technology, represents usually the highest share of the wealth. The solar and wind do not, at least as of 2017, they have not generated yet positive wealth. They have not generated rents, which is normal for the relatively new nascent technologies where the early stages of deployment very much rely on subsidies, and subsidies do not count to the value of wealth. But if you look at the next slide, when you look at the trends of the unit rents, unit resource rents, they are very quickly, especially for solar PV, very quickly approach positive value. So probably by now, most of the wind and solar resources would generate positive economic rate and contribute to the value of Japan as a nation, as well as for other countries. We've done some simulations for Africa, for a few African countries that are rich in fossil fuels, like South Africa and coal, and we compared that, with the right policy framework for electricity markets and for carbon pricing. The value of solar resources in South Africa very quickly can exceed the value of coal in the country, and for Angola, which is rich in oil and gas, with the same enabling policy framework, the value of oil would very quickly, the value of renewable energy would very quickly exceed the value of gas. Well, oil is quite valuable, so it would take a little bit more time. But it means that with the right policy framework, more countries should include renewable energy in their balance sheet because it is an important missing unaccounted wealth of nations, despite all the policy support to it. So the last slide is about policy recommendations that come out of this analysis. So in this year's Changing Wealth of Nations, we are not just providing a new accounts of the Changing Wealth of Nations, but we're also, as you have seen, we've provided a lot of analytical insight into how the wealth accounting and the analysis of wealth can very usefully complement the economic analysis, macroeconomic analysis based on the traditional flow accounts, the GDP, the fiscal flows, and so forth. So first of all, we recommend on this basis that the countries should measure and monitor wealth. Although Changing Wealth of Nations provides the world's most comprehensive and most rigorous database of the Changing Wealth of Nations of the different wealth components. So this is the most comprehensive wealth database that there is in the world now. Nonetheless, it is a top-down database based on the internationally available databases and methodologies. So, but we would encourage each and every country to introduce also bottom-up accounting of wealth, because what is not measured will be mismanaged. Second, the wealth accounting methodology and the analytics based on it shows that countries should really invest in the comprehensive wealth. And it is especially important to mobilize policy support to create enabling conditions for both private and public investments in those wealth components that are public goods, so traditionally are mispriced and are underinvested by the normal markets. Policy intervention, creating the property rights regimes that would enable both public and private investments in this most mismanaged and mispriced components of wealth, human capital, natural capital in particular, are important prerogatives for making the future growth and prosperity sustainable. This brings us to a lot of analysis of what kind of policy framework, policy incentives would be needed to protect and increase the value of wealth. The current markets often over-reward the traditional capital, the traditional produced and underground fossil fuel capital, and undervalue and underprice the natural and human capital. So this leads to the degradation and depletion of those components of wealth that are essential for future sustainability of development, and creates more and more often the systemic macro-fiscal risk, systemic stability problems, including the potential existential risk to humans, as we see in the case of the climate change, in the case of ocean diversification, in the case of the nitrogen cycle disruptions, and so forth and so forth. So again, policy framework is extremely incentive so as the economic agents do not deplete, do not misuse, do not overuse, and do not degrade the essential components of wealth. And the last policy conclusion is about diversifying wealth. So traditional economic recipe focuses really on the diversification of economic output, diversification of exports. But what we see is that in the current world where some of the important risks related to global sustainability are threatening the wealth portfolios, traditional diversification may not be enough, and may actually increase the exposure to the systemic risk, for instance, of low carbon transition, because it is perfectly okay from the traditional diversification recipe for instance, fossil fuel rich country to diversify away from oil and gas into downstream heavy industries that use oil and gas as input and are very emission intensive. And that means that what such diversification that manages very well the cyclical risks of fossil fuel and other commodity price volatilities may actually increase exposure to the risks of low carbon transition, such as climate policies, technology policies, market access policies, border carbon adjustments of other countries. So we call for the much broader diversification of assets on which the economy depends, the assets that the economy is using to create annual output and make this output sustainable. Thank you very much for your attention, and we're happy to take questions. Thank you. Sorry, now I hand over to Stephanie to bring us a little bit to the discussion of the resilience and sustainability as the drivers of our thinking about the future changing world of nations. So Stephanie, sorry about this premature conclusion of our presentation. The floor is yours.
No worries at all. So we thought we conclude this event just giving you a brief outlook on our thinking about the next edition of the Changing Wealth of Nations. As Jim and Grzegorz have so nicely explained, this is a series of flagship reports that started now several decades ago. And the idea is to continue building on this tradition, which has always been to push the boundary, to break new ground, particularly from a methodological point of view, from increasing the coverage, particularly of renewable natural capital. And more recently, in this very last edition, there was a major innovation by introducing this forward-looking policy analysis. And this is something that we would like to build on in the next edition of the Changing Wealth of Nations. Next slide, please. So what we would like to tackle, one issue that is a challenge with the current methodology, and just something that we want to start thinking through, is how we could potentially incorporate strong sustainability concerns into the current methodology of computing comprehensive wealth. So the main challenge currently is that we essentially use a concept called weak sustainability, which essentially means that we can perfectly substitute across the assets that make up comprehensive wealth. To make a very drastic example, the idea would be if a farmer draws down his aquifer in the production of agriculture, but purchases a tractor instead, then in a way the aquifer and the tractor would be perfect substitutes, which I am sure we can all agree they are not. However, of course, the question is, to what extent is it possible to introduce at least imperfect substitutability across assets? And as you can imagine, this is a challenging task. And what we would like to do in this next iteration is just to start thinking about what does it mean to introduce imperfect substitutability across assets, as in, for instance, natural capital and produced capital. What does it mean to introduce imperfect substitutability within an asset class? Just think of water and forests within renewable natural capital. And also, what does it mean in the terms of the scale? Of course, at the global scale, it is reasonable to assume weak sustainability. But as you drill down on a smaller local level, those concerns will actually be real. And so the main question now is how we would introduce that. And we want to explore this primarily from a theoretical and empirical lens, and then see to what extent this could inform revisions of the methodology going forward. Next slide, please. The second key aspect, of course, that we are going to do as part of the Changing Wealth of Nations, and this is something that the report has done over the years, is to continue expanding this coverage, and in particular with a focus on renewable natural capital. So this chart here that you can see is, of course, very familiar to the chart Jim earlier introduced, showing the overall coverage of what currently goes into the comprehensive wealth accounts, again, with our different subcategories. And what you can see in italics is the idea, is the elements that we're planning to add as improvements in the next iteration. The biggest ones are that we want to introduce 2 additional components of renewable natural capital. The one which Grzegorz just spoke about is to introduce renewable energy as an account for all countries, so please expand the country coverage from the current pilot. This was important, innovative work that was done in the current edition. We want to build on that and see to what extent we can produce renewable energy accounts for as many countries as possible. The other key aspect of renewable natural capital that is currently missing is water. And this is particularly challenging because of data constraints, because water is very heterogeneous and there's a lot of spatial heterogeneity as well. But we would like to at least take a first pass at it to see if we can introduce one potentially fairly simple global water account, and then perhaps do a regional pilot, for instance, in the Middle East and North Africa region, for which there's a lot of information, and which is, of course, a very water scarce place, so it would be important to do. Then in addition, we are planning to add a few more ecosystem services, most notably carbon storage. There is now data available and at least some first agreement on how to value this. For fisheries, we want to include, for blue natural capital, we would like to add aquaculture. As Grzegorz earlier mentioned, currently we only capture fisheries, but of course, as capture fisheries have collapsed, aquaculture has expanded. So we feel we would like to tell a more complete picture. Next slide, please. The last aspect that we would like to add is to make an even more conscious effort to try to streamline natural capital into economic analysis and answer big policy questions on sustainability as well as climate change. How we're going to do that is that essentially we would like to upgrade and expand one of the key toolkits that are in the macroeconomists toolkit, which is of course CGE models. And in essentially what we would like to do is to take these CGE models and look at the key assets that are currently used as a basis for developing these CGE models, which is typically physical capital, some form of human capital, non-renewable natural capital, and first of all, insert renewable natural capital into it. There have been some first attempts to do this, specifically in several countries, and we want to build on these efforts. And then more importantly still, we want to model not only how this asset base then translates into in a CGE model, but also how the impacts of how economic decisions ultimately impact the ecosystems. And so how this is going to be done is that you will have a CGE model that predicts changes in land use based on the optimization going on in the model. And this will then impact the ability of the ecosystem to provide ecosystem services, which would again be fed back into the CGE model going around in a loop. Currently, models exist that allow us to model pollination services, timber, carbon, fisheries, and we're hoping to add a few other, particularly several regulating services, to just get understanding of kind of, how can you really model these interactions between the economy and the environment. And of course, this is not in a vacuum. We all know that our climate is changing and that we need to understand how the climate impacts not only the economy, but also the environment. So we will introduce some scenarios where we look at both, the optimistic as well as pessimistic scenario of climate change impacts that will include impacts in the CGE model on labor productivity, on the asset base itself, as well as on the ability of the ecosystems to continue to provide services. This will ultimately then give us an idea of how vulnerable GDP is to these different climate change impacts, and also how vulnerable our portfolio of assets is to these different climate change scenarios. And then once this model is all set up, we can then proceed to answer key policy questions from the environment perspective. Of course, one key idea would be to discuss to what extent ecosystem restoration can have important co-benefits, both for resource management and sustainability, as well as climate change. But there is a breadth to expand this to including, as Gregor was just saying, carbon border adjustment measures, since this is a global trade-based model, etc. And so depending on our funding envelope, we can expand the menu of policies to be considered. Next slide, please. So I think at this point, we would like to thank you very much for your time and your interest. We look forward to your questions, and many thanks for inviting us to come speak at this event. Thank you.
Thank you very much, Jim, Grzegorz, and Stephanie for your keynote presentation, including special analysis for Japan, and also even introduction to the next edition, 2023 edition of the report. For the viewers, the PowerPoint, which was just shown on the screen, has been posted on our website, so please fully take advantage of them. So let me read the question that we received in advance from our viewers. The first question from Sasaki-san, thank you for your question. If a new proposed method of the measuring wealth of developing countries is used instead of GDP to measure economic growth, how would it make changes on the ways of operating models of various programs and activities of multilateral development banks such as the World Bank? Currently, international cooperation activities are aiming at growing economies in GDP terms. So this is the first question from the Sasaki-san. So if you would like to respond, please. Thank you.
Thanks very much. I'll have a go at sharing some of our ideas on this question. So the first thing to say is that the wealth accounting approach that the World Bank has developed is really intended to be a complement to GDP and other conventional economic indicators rather than a replacement. So we talk about looking beyond GDP, recognizing that GDP will remain an important part of the toolkit that economists and policymakers are using to design development strategies. But one of the things that a comprehensive wealth perspective allows you to do is to think more carefully about the sustainability of development, looking at the assets underlying GDP rather than just focusing on headline GDP growth. As we explore in the report, you can have situations of contradiction where you might have very high GDP growth or positive GDP growth, but it might be coming at the expense of your assets. It might be coming, like the example Stephanie shared, farmers degrading their aquifers, overusing water, for example, or one of the examples Grzegorz gave, overfishing. Yes, that can lead to short-term economic gains, but it's going to be undermining the sustainability and the base of assets that countries are going to rely on into the future. Thanks.
Thank you for your responses. Next question from Mori-san. Thank you for your question. The analysis in the new report is based on the data till 2018. What is your preliminary view if analysis is made, including the COVID-19 pandemic?
Thank you. Yeah, so our database goes up to 2018, of course, doesn't fully capture the impact of COVID-19. However, we did do some simulations in this latest report. And so you can download the chapter focusing on human capital and the impact of COVID-19 to see some of our analysis. Now, of course, it's very preliminary because we still don't know the full extent of the impact on human capital wealth and on other kinds of wealth from the pandemic, both in terms of the devastating loss of life and health implications, but also the broader economic implications. So the major economic shocks that have rippled across the global economy and are still not over. So in our preliminary analysis, what we looked at was the implications for the growth in wages over time. And so just looking at this one narrow dimension, this already has significant implications for how human capital wealth could be lower in value going forwards as a consequence of COVID-19. But what we weren't able to take into account for this report, at least, was wider implications such as the health and wider economic consequences, because they still haven't been fully realized yet. Now, the World Bank is working on other strands of this analysis. The chief economist for human development at the World Bank has a report coming out soon, I think early next year, that really goes into more detail exploring the implications of COVID-19 on human capital. So I encourage viewers to check that out when it comes. Thanks.
Thank you for your responses. We received several questions from the anonymous participant as always. Thank you very much for your question. Let me read some of them. Will you include cultural affluence, people's well-being, including leisure time measurement, biodiversity, etc., into the measurement? Institution and law are measured in some part. What is the method to decide which legal and social systems be the subject to be measured?
Maybe I'll take up this question, which is a difficult one, an interesting one. So for cultural affluence, people's well-being, leisure time, part of it is implicitly captured by the value of human capital, which is measured, as I mentioned, as the lifetime earnings of employed and self-employed people. So in a way, you can assume that greater cultural affluence leads to higher labor productivity, hence the higher wages. But most of these variables probably require satellite accounts and are difficult to be captured in the SMA social so systems of national accounts compatible accounts of monetary wealth. Biodiversity, as Das Gupta report pointed it out as well, we share the same view that biodiversity is a characteristic of an asset rather than an asset itself. So I don't think there is any plan to measure biodiversity as an asset. We measure several different natural renewable capital assets, and then we can, going forward, we can have a measure of the diversity of that assets rather than capture biodiversity as a chunk of wealth itself. And with institutions and law and social and legal systems, this is a tricky thing because so far, and again, we want to keep the rigorous methodologies of national balance sheets and and systems of national accounts. So, from the point of view of this rigor, all these social systems and institutions are more assets in the metaphoric terms. So they are assets as metaphors rather than the balance sheet ready items. But we understand that they have a lot of impact on the value of other assets. So we have included a special chapter in this Changing World of Nations. The last chapter is about social capital. What can we learn to the world that comes from social capital?
Thank you for your responses. Let me read two more questions from the same person. So the next one, regarding human capital, what is your plan to include the quality of education? Would you include a literacy rate? If calculated by years, it may count repeating or consecutive years. School attendance dropout, entering age, leaving days may be omitted. Of course, there are a lot of things to be considered from the quality of education perspective. And one more question from the same person. Life expectancy is considered, and I wonder if you add the healthy life expectancy, which may be closely related to natural capital or artificial capital.
Yeah, so both questions are related to human capital. And with the first question, the quality of education, literacy rate, and years of schooling, attendance, dropout rates, and so forth, these variables we are not measuring directly because these variables, according to the methodology that we use, are already implicit in the lifetime earnings. So more educated labor force, people with better educational outcomes usually tend to earn more, so their wages determine higher value of human capital. But as Jim said, the World Bank has a complementary measure of human capital index, which goes into the non-monetary valuation of all these variables in detail. So we are providing monetary value, which embeds all these variables implicitly, but then you can look for more details in this complementary measure of the human capital index. And the same for life expectancy and health. We believe that this methodology that we apply captures life expectancy and health, again in the lifetime earnings. But to test this hypothesis in a way, we have included a chapter which looks at the impact of air pollution, which is a particular feature of natural capital, on human capital. So we did find a significant impact of deteriorated air pollution on premature deaths, which translate into the lower lifetime earnings, hence lower value of human capital.
Thank you for your responses. We received a question and comment from Professor Yoshino of Keio University during the presentation. So let me read his comment and question and ask in order of Jim and Grzegorz and Stephanie, not only to respond, but also say a few final words before wrapping up our seminar, as we are getting closer to the end of our seminar. So the Professor Yoshino's comment and question. Human capital development will be enhanced by remote education. If top teachers can give best lecture by use of mobile technology, all children can listen the best lecture, which will make them to understand much better. Internet and broadband network needs to be expanded to conduct best remote education. And his question: fossil fuels will decline drastically. Then what would it change the global waste distribution and capital flows globally? Will the World Bank estimate changes in the amount of wealth and global capital flows? So that's his question. I would like to ask Jim, in order of Jim and Grzegorz and Stephanie, to respond and also say your final words before wrapping up the seminar. Thank you.
Great, thanks very much. So I'll pass to Grzegorz the specifics of the question as it relates to fossil fuel wealth. But of course, the bigger question here is about how the distribution of wealth is going to evolve over time globally. This is one of the questions that we think about in this report, and we start to look at the policy implications of choices taken today and in terms of how that will shape wealth going forwards. And as you saw, one of the main policy messages coming out of this report is that a diversified asset base, one that isn't overly dependent on fossil fuels and other kinds of non-renewable assets, is one that sustains development going forwards. And so securing future prosperity is not just about GDP growth. It's actually about paying attention to the underlying assets, and for policymakers to be more deliberate in terms of investing in their natural capital and their human capital, as well as their produced capital, in a way that GDP is not a good signpost for designing those kinds of policies. Thanks. Over to you, Grzegorz.
Yeah, just to add to it, that you know, the future, especially the disruptive changes related to you know, to this global mega trends related to digitalization, as Professor has mentioned, but also to the response to the global climate crisis, to the global oceans crisis, a lot of environmental risks are leading already to the major rebalancing of the wealth portfolio of countries. And we are just starting to learn what does it mean for the resilience of the development, for the sustainability of development, for the stability of the development, for the macro-fiscal risks of the countries. But definitely, over-reliance on the most exposed and vulnerable asset classes will lead to disruptions. And just a small comment of this huge wealth discrepancies per capita that we see, and that really worries us a lot. You take a person, an educated person from Bangladesh, and you just move this person to Japan, and overnight the value of her or his human capital, increases 20 or 30 times. And that is a worrisome trend that, if that means that the human capital and other wealth will flow from the countries where the value is lower to the countries that the value of human capital is much higher, this can only increase these disparities. And if we don't create the enabling conditions for the wealth to flourish and for the wealthy investments in the low income countries, we can have this very vicious circle of self-perpetuating concentration of wealth in very few countries, which can be have very devastating impacts on the stability of the world order.
To add on my end, other than you have raised very important points, and this is exactly where we're trying to go with the next edition of the Changing Wealth of Nations. Of course, we will continue to produce the data. We will continue to expand the boundaries of the data, but there will be an increasing shift exactly towards this analytical work where we start adding this forward-looking analysis, looking at scenarios, both as Grzegorz was saying, these broader global trends that we are observing, as well as then analyzing specific policies that can, at least from a global level, give policymaker pointers for their specific context, understanding not only how vulnerable their GDP is, but also how vulnerable or resilient, if you want to package it that way, their portfolio of assets is. But what we always stress is that what this database is, it is a global database. It is a starter for a dialogue, but then if for your specific country, you would like to know, so what should Japan do? What should Bangladesh do? What should the United States do? You do need country level analysis. And so ultimately what we're always advocating is that, of course, this global database can highlight vulnerabilities. It can help us talk about economic sustainability at a global level. But ultimately this data, especially on natural capital, needs to produce bottom up at the country level so that you can then tailor the models to your specific country context and then actually get specific policy guidance that governments can implement. So thank you very much, Brigitte. Back to you.
Thank you very much. We had a pleasure of having Jim Cast, Grzegorz Peszko, and Stephanie Onda connecting us from Washington, discussing the Changing Wealth of Nations 2021 edition with the introduction of even the 2023 edition. So thank you very much, all of you, for joining us this morning. Really appreciate it. Thank you. Great. This is the end of our morning seminar programs in the calendar year 2021. Thank you very much for watching our seminars and sending your questions to the speakers as always. Enjoy your holidays. Wishing you a best happy new year. Stay safe, stay healthy. We'll see you in January. Thank you very much.